it's sustainable until it's not. And everyone's been debating this for 40 years. In the mid 80s, people were talking about the Reagan deficits and all the debt that he was accumulating, and the rise in defense spending and so on. And eventually it would matter. And then Dick Cheney, of course, said it doesn't matter. And I do believe now it matters. I think all you have to do is look at the price of gold and see what's going on in the UK gilt market, and just everyone talking about it tells you that it matters, and that we haven't repealed the laws of supply and demand. To foreigners, it matters because they're buying less of our treasuries. So I do think that it matters, but in order for it to matter for Washington, D.C., is no one is going to say, hey, let's get ahead of this curve. There'll only be a response when you either get a tanking of the dollar or the 10-year yield goes to 6%. That's the sort of the bell ringing in D.C. to say, okay, oh boy, we have a problem here. We have.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a fantastic discussion lined up, and we're fortunate to have with us Peter Boockvar. Peter's the Chief Investment Officer at the Bleakley Financial Group. They manage more than $10 billion in brokerage and advisory assets and have more than 160 wealth advisors, management, and support staff. In addition to his role as Chief Investment Officer during his career, Peter spent time as a macro analyst, portfolio manager, managing director, and partner. Peter is a coveted speaker, regularly does interviews on CNBC, Fox Business, Bloomberg, and other outlets, and he's also the founder of the Boock Report with Peter Boockvar. Peter, thank you so much for joining us today.
Thanks, Gary. Good to be here.
So let's begin with the Fed. As for the Federal Reserve, we heard a lot before the first rate cut in September from Jay Powell and company about needing confidence that inflation was falling to target in a sustainable fashion in order to start cutting rates. While in the coming months, the inflation stats could continue to disinflate, can they really have confidence that inflation will stay down in light of the potential economic and market reaction to the election yesterday, among other things such as the high fiscal deficits, de-dollarization efforts by the BRICS, and more?
Well, if Jay Powell is honest with himself, he'll go into this meeting and compare notes to when they last met in September and see where yields were then. Now, granted, yields had fallen going into that September meeting, but to see the reaction in the markets, both on the short end of the curve and the long end of the curve, was quite stark. In fact, if you look at the Fed funds futures market and what it was pricing in on September 16th, the day before their meeting, it was pricing in a year-end December 2025 Fed funds rate of about 283. Today, as we are speaking, that level is about 383. So the market has taken away 100 basis points of cuts. Then you throw in the last core CPI number, which was a little higher than expected, core PCE, which was still in line, but still above its 2% target. Very confusing jobs data. And then, of course, the election and the inflationary reaction to it, if you look at the TIPS market and sell-off in treasuries. So if you're a responsible banker, and I forgot to mention, you look at the price of gold outside of the pullback right now, but the elevation in the price of gold too is sort of a repudiation, in addition to the rise in yields, to what the Fed did. So just from a responsibility standpoint, shouldn't you just not do anything at the November meeting? Do you really have, to your point and what Powell has said, enough confidence that not only will inflation continue to disinflate, which I think it will in the next couple of months and quarters as the rental component softens, but can you really have confidence that it stays down? And just to highlight the rental component, if you break now, and I highlight this because we know it's the biggest part of CPI. It's 40% of the core. It's about 30-ish% of the headline. The Sunbelt states is where the deceleration in rental growth is taking place. If you look at the coasts, both east and west, and also the Midwest, rents are still rising. And what was very notable to me, on one hand, was the softness in rent growth that Camden Property Trust had mentioned, full disclosure of stock that we own, because they're heavily allocated to that. On the flip side, Avalon Bay, which has properties on each coasts and a few inland ones, they talked about the possibility of reacceleration on the rent side. I highlight this because I've been in the camp that we're not magically going back to a 1 to 2% inflation target and staying there. That inflation volatility is the new normal. And after this deceleration, I think inflation stats start to tick up again, and that's going to highly complicate the job of Jay Powell and the Fed, and gets to my earlier point that how does he have enough confidence going into this November rate cut, if he does follow through, that what he is doing is the right path, particularly after cutting 50 at the September meeting and seeing the response to it.
So do you think that cutting 50 and saying he's going to cut 25, or not 50, but we're still going to cut, implying 25, do you think that was politically motivated?
I don't. From Jay Powell's perspective, was it political and maybe some of the members? Possibly. But we have to remember two things. Trump hated Powell, bashed him on a daily basis to cut rates. And Joe Biden did not want to reappoint Jay Powell. He wanted Lael Brainerd. So I don't think Jay Powell cares about either. And I only think he cares about is his legacy, because I don't think, even if Trump said, okay, Jay, do you want this job again? I don't think he wants it. He's done in the early part of 2026, and I think he only cares about his legacy, which you'd think if that's what he cares about, then he would not cut rates in November, maybe wait till December till he gets more information. I'm not saying he shouldn't be cutting again. I'm just saying that from a responsibility standpoint, you can always wait until December. I mean, that's the thing about Fed meetings. They're about every 6 weeks. So if you don't act on one, you can always do it the next one. But to your point, I don't think he is political. Now, granted, yes, he's a Washington, D.C. insider. He has his coffee talk with congressional people, and he's in that world, and I'm sure he gets pressured. I'm sure he thinks about that. But I don't think he made a move to try to influence the election. He's going to be remembered about the inflation spike, his ability to control it, and his ability to avoid a recession and keep inflation down. That's how people will remember Jay Powell, not whether he tried to influence an election or not. That's in his mind.
Yeah, and they'll likely remember him for the one key word, transitory, right?
Correct.
So, Peter, most pundits, analysts, experts today are believing the Fed has achieved a soft landing. Did the Fed avoid paying the piper for all their printing and other choices post-pandemic, or do you believe there's some pain still to come?
I think it's not just any cliche anymore that rates are staying higher for a while. And there's still a lot of debt that matures over the coming years that is going to reprice at much higher levels than the loan that's on these bonds that were priced before 2022. And you take the real estate market, for example, and just an anecdote, and got a text from a friend today saying the loan that he was trying to refinance on a project that he has, bank walked away today because of the spike in interest rates related to the Trump election and the move up over the past month. So I'm not sure what he's going to do with this project, and you can imagine others that are feeling the same thing. So I don't think that we can rest easy as long as, again, there's this very large maturity wall that we have to work through in the next couple of years with debt that was, again, priced pre-2022 that is going to reprice at current rates. So historically speaking, yeah, rates are somewhat normal, but after 15 years of zero, there's still, I believe, more acclimation, more digestion to this higher rate environment that needs to be had.
Does the current debt and fiscal dominance playbook stay the course with Trump as president? And if it does it get worse and worse until it ultimately leads to a crisis and a financial reset of some sorts, either in his term or in a subsequent term? Or is there a way out before crisis hits?
Well, as we know, because of the entitlement situation and the mandatory spend, and now interest expense on top of that, with rates staying higher for longer, as we said, it's very difficult to get out of it. Now, can Elon Musk come in and slash and burn the cost structure of the federal government? Yeah, maybe. Unlikely, as it's been tried before. I mean, it was Ronald Reagan that talked about getting rid of the education department, and here we are 40 years later, and it's even bigger and more expensive. So I think it's easier said than done. Uh, until you touch those entitlements, until you tweak those, and I say tweak because all you need to do is slow down the rate of spend, and you can make a big difference. I don't see how we manage this. Can we grow out of it? Ideally that would be the case. But the thing with Trump's policies is in 2016, there was a lot of low-hanging fruit in terms of the tax code. He had a big corporate tax rate that he can cut. He had a lot of tax cuts at the personal income side that he was able to cut. Now, at best, I think it's about just keeping them stable. Now, the corporate income tax, that does not expire, but I don't see him cutting that further. I don't think he'll be able to. And on the income tax side, at best, they get renewed after they expire at the end of 2025, and they stay the same. So there's not that sort of fiscal impetus like we had in 2016. So I'm not sure if the economic growth rate has the ability to accelerate from here. Now, in terms of capital spending and consumer spending, there was a lot of talk in earnings calls that some decision making is being held back until we get the results from the election. So we'll see if that plays out. I doubt that's really the case on the consumer side, maybe on the capital spending side. So we'll have to see. But on the other hand, we have to see how the economy takes a pickup in tariffs, and whether the tariffs are narrowly focused on certain industries and sectors, or it's a scattershot approach, which I think would be more deleterious to the economy rather than more pinpointed tariffs.
And to your point regarding the entitlements, there really isn't a example we could point to where just one party focused on the entitlements and made a massive change to the entitlements all alone. They really have to work together. And they were not really given a mandate this time to go to Washington to fix the entitlements. So it seems like maybe Elon could get something done on the margin, but it just doesn't seem like he's going to be able to make a difference to the fiscal train that's already set in motion.
I agree. I think it's a difficult thing to tweak because a lot of that spending comes from the congressional side. So it would be, ideally you want government to be more efficient, but that's almost an oxymoron to be more efficient. And we'll see. It'll be interesting to see whether he will have the ability to do anything. But it's tough to think that the fiscal side is going to sort of work its way out of this. And if you have interest rates that potentially can go even higher on the longer end, because I think the shorter end is still going to be somewhat tethered to expectations of Fed policy, then government and new policy can only do so much.
So, cost cutting is good, and it's right, and it's responsible, but it would also mean jobs lost, spending lost. If they actually were able to slash $2 trillion from the budget, what kind of impact would that make on the economy and the markets in both the short and long term?
Well, I think the $2 trillion number will never happen just because so much of the government spending, is mandatory. I think I
was really just trying to get to that. It's a fictitious number, but if that were to be pulled out of spending, what would that look like?
Well, in the short term, I guess you can say it would be a negative impact on growth. But on the other hand, if we can stabilize government finances, take money out of the federal government and put it back into the private sector, I think we would be able to power through that. So I'm not worried about any short-term negative impact from reduction in government spending. I think the private sector would just be fine with it. Taking that money out of the public sector. I mean, you could argue that with all this government issuance that there is a crowding out effect that's taking place.
Yeah.
Now, there's no loan growth in the commercial banking sector. The ability to raise money is really in the capital markets, but you can only do that if you're a bigger cap company that has access to it. If you're a small cap company, it's tough to get a loan from a bank, and even if you get one, it's costing you 10% to borrow. So I do believe that there's a crowding out. I mean, every person that buys a T-bill because they're loving the yield or puts money in a treasury money market, that's not money that's sitting at a bank, because the banks, in a way, don't want it because they're not paying you a high enough interest rate to entice you to park their money there. That's $1 less money that is able to be loaned to the private sector.
So you mentioned, growing our way out of this. Around the time that Ronald Reagan had been in office for about a year, January of 81, the national debt hit 1 trillion and GDP was about 3 trillion. Today, debt is at 36 trillion and GDP is at around 29 trillion. So debt has done a 36x and GDP has done less than a 10x in the last 40 plus years. Is the faster and escalating debt growth rate over GDP growth rate sustainable? And if not, what is the likely outcome of that?
Well, it's sustainable until it's not. And everyone's been debating this for 40 years. In the mid 80s, people were talking about the Reagan deficits and all the debt that he was accumulating, and the rise in defense spending and so on. And eventually it would matter. And then Dick Cheney, of course, said it doesn't matter. And I do believe now it matters. I think all you have to do is look at the price of gold and see what's going on in the UK gilt market, and just everyone talking about it tells you that it matters, and that we haven't repealed the laws of supply and demand. To foreigners, it matters because they're buying less of our treasuries. So I do think that it matters, but in order for it to matter for Washington, D.C., is no one is going to say, hey, let's get ahead of this curve. There'll only be a response when you either get a tanking of the dollar or the 10-year yield goes to 6%. That's the sort of the bell ringing in DC to say, okay, oh boy, we have a problem here. We have no choice but to do something about it. And it'll be interesting to see how Rachel Reeves, the Chancellor of the Exchequer in the UK, whether she changes her budget in response to the market reaction to what she did. People blamed Liz Truss. She actually wanted to generate economic growth through tax cuts. It's Rachel Reeves is doing the opposite, raising taxes and spending a lot of money. It's her that I think is more guilty of upsetting the gilt market rather than Liz Truss. But it's only in a crisis is there a government response. Until you get one, they'll think that the party can continue on.
So you mentioned that it does matter to foreigners. Well, Peter, foreign holders of U.S. Treasuries dropped from 41.4% to 33.2% from June of 2019 to June of 2024.
And it was about 50% 10 years ago.
And then the Fed, it's increased its holdings from 13.2% to now 18% in the same time frame. What are the implications of that trend, especially in light of the type of issuance that they're putting out?
Well, the other big buyer has actually been the hedge fund community via this basis trade, where they buy cash treasuries and short futures and try to capture a slight spread. If you look at the monthly Treasury International Capital data, the Cayman Islands keeps popping up as a major buyer each month, and that's where some of this basis trade
that's
is
a big population
place.
center these days, right?
Yeah, exactly. So the government in the Caymans didn't just wake up and say, hey, I want to own a lot of U.S. treasuries. So they're actually helping to finance the U.S. government, in addition to institutional and retail that are enticed, of course, by these higher rates compared to the 15 years into 2022.
Are you worried about the trend that's happening where the foreigners are decreasing their holdings substantially and the Fed is increasing?
Well, that sort of correlates also with the rising price of gold, where a lot of these surplus money that's being generated outside the U.S. is not being recycled into the treasury market. Particularly emerging markets are finding other things to park that money in. So again, it matters until it doesn't, or I should say, it doesn't matter until it does. But these are the things that we have to watch for. We've, and not to sound hyperbolic, but with the sovereign bond market, and it's not just in the U.S., it's global. When we had $18 trillion of negative yielding bonds a couple of years ago, it was the biggest financial bubble in terms of dollars in the history of financial markets. And it is now unwinding. And after a 40-year bull market that culminated in that, doesn't just end in a couple of years. So, and I've said this for a couple of years to my readers and other interviews, is that you can't just look at the long end of the yield curve and say, okay, I think growth is going to do this, I think inflation is going to do this, and here's my call on the 10-year. There's a lot of other dynamics here at play, and I think higher highs, higher lows is going to be the trend in the 10-year and the longer end of the yield curve, irrespective of the Fed. And I say that because we've seen what happened when the Fed tried to cut short-term interest rates.
Won't that have a impact on the residential real estate market, the prices?
Of course, we've seen a big rise in mortgage rates since that Fed meeting. We went into that Fed meeting and just a few weeks after, and everyone was hopeful that the Fed is here to the rescue. And a lot of companies conference calls, they mentioned, yeah, we're lower interest rates, and we expect so and so to happen thereafter. Well, that hasn't worked out so well. So yes, there's a problem, and just even today we saw a big decline in mortgage applications week over week, with another rise in the average 30-year mortgage rate, coincident with that rise in the 10-year.
So you recently wrote, for stocks, the key from here is, at what point does this rise in interest rates matter as the 10-year yield is approaching 4.5%, and the S&P 500 now trades at 24 times 2024 earnings estimates. Would you speak into that for us?
Well, valuations don't matter until they do. What's the difference between an 18 multiple, 20 multiple, and a 24 multiple when people want to, own stocks and take risk? It does begin to matter more when, rates trajectory is higher. And I don't know the answer at where the 10-year yield needs to go before stocks care. Obviously, the current level of 4.45 doesn't matter because we're at a fresh record high. Now, whether it's 4.5, 4.75, 5, I don't know. But at some point it will. And it will from also, an economic standpoint, because every day there's refinancing that needs to take place. There's a new loan that needs to be taken on. And there was this belief that the Fed was going to, again, save the day. And I mentioned the story earlier with that anecdote with commercial real estate. You have a lot of commercial real estate people that really thought that Fed rate cuts were going to ease the pressure that any of them were under if they had debt coming due. And that that relief is just not going to be there anytime soon.
So, Peter, former economic policymaker and financier David Stockman, I'm sure you know who he is, he recently warned that everything is overpriced, everything, and that it's going to be near impossible to continue the current high levels of deficit spending without restoking inflation. He also stated that it would not surprise him to see a 30 to 50% downwards correction in financial asset prices beginning next year, as stocks, bonds, and real estate are all overpriced. Do you align with David's perspective for the markets and inflation here?
Well, I like David. I respect his opinions, but it's something that he's been saying for a while, and I understand the concerns and I echo them. But trying to figure out when it matters has been very difficult. I do believe, though, that looking at, again, the price of gold, looking at treasury yields, not just in the U.S., but I mentioned the U.K. and that it is beginning to matter. And I just don't know what that trigger point is. Now, we're obviously today in this Trump honeymoon again, as people sort of replay of the playbook of 2016 after he won, when the market opened down and then had a major reversal. So I do think higher rates at some point is going to matter, and rates will continue higher, I believe. I just don't know the timing of that, but certainly being managing other people's money, it's something that we have to be alert for all the time.
So is the 10-year like a certain benchmark, the trigger that you're looking for, or are there other trigger warnings that you kind of have in your crosshairs that you're paying attention to, that you believe if it maybe hits these zones, we may end up be kicking off the very type of thing that David Stockman is warning about?
Well, yeah, yes, the 10-year, just because it's market driven. I also believe the value of the dollar. I go back and forth, in terms of where I think these concerns manifest itself in. For a while, I thought, okay, it would be treasuries. Maybe we'd have a failed auction. We'd have a jump in interest rates like we did a couple of years ago with the liability-driven investment blow up in the UK gilt market, where the BOE had to step in and buy gilts. And then I sort of thought, well, maybe it's going to be more the dollar. Maybe it's the weakness in the U.S. dollar that will reflect the unappetizing level of U.S. debt. And now maybe I'm back to treasuries being a reflection of that, or it's the price of gold that's a reflection of these concerns. The price of gold's not at $2,700 or below that after this pullback, just because people like the shiny metal. I mean, it's there for a reason, and it's not just Western investors chasing, because they really haven't been. It's Eastern investors and central banks that have been buying it to hold it and store it and keep it. Yeah. And they do that for a reason, and they've been in price insensitive for a reason. It's not just because they woke up one day and they like, the color yellow, for example.
Okay, so it sounds to me like there's several triggers that you're paying attention to, that in the event that these move into the overheated territories, you're going to be on high alert for a potential pullback.
Yeah, I mean, in the risk management business, you have to be. And yes, we're in the asset management business, but I'm of the one who's always been, a natural cynic when it comes to things, and always watching my back, because I feel like if I can do that, the upside will take care of itself. But there are risks out there, and I think when you have a multiple like we're trading at, you just have to be more cognizant of these risks. If the S&P was trading at 14 times earnings, I'd be a bit less worried about how markets respond. But when you're trading at higher valuations, you have to pay attention to these risks. And again, they may not manifest itself for a while, but I still think it's prudent to watch for these things, particularly for clients that are 75 years old or 80, and
right.
They can't afford another bear market.
And most of them are still so heavily allocated towards stocks. Last I saw, it was in the 65% range for the boomers, and I guess they should be more in the 35% range. Is that correct?
Yes, and as a percent of total assets, the equity holdings are at a record high, and there's just this general belief that stocks can never go down. If you look at the October consumer confidence data from the Conference Board, since 1987, this question was first asked: do you think the stock market will be higher or lower in the coming 12 months? And in October of this year, a record percentage said higher. So there's just this general assumption that always works out. And with that mentality, you just always have to make sure that, like I said, you're watching your back, because whenever these assumptions are in place, you don't want to see another 50% decline in the markets like we saw twice within 10 years back in the 2000s, particularly for that older client.
Yeah, I appreciate your risk management perspective. So, Peter, with the win by Trump last night to become president and what looks to be a likely sweep by the Republicans in the House and Senate, the markets, as you've mentioned, they've just taken off today. They've gone parabolic. With the market already trading at the 24 times earnings that we've mentioned, are the markets now setting up for a blow off top?
Maybe, and maybe the response to the Trump win is that. We'll have to see. The one positive for the market is since the July previous peak, the market has broadened out a lot, which from a breadth perspective is positive. It hasn't been just those obsessive big cap names that everyone has loved. So that's one positive. Now, whether this is sort of a false breakout, I don't know. I'm happy to see the broadening out because we're long other things other than those big cap names, also internationally as well. But we'll have to see.
So there's a staggering amount of capital, and I think you've kind of touched on it earlier, parked in the U.S. money market funds. It's currently sitting near $6.5 trillion, and it's collecting interest rates at over 4.5%. As the Fed eases, if they actually do ease down to the levels that initially were thought, a flood of capital that's sitting in those money markets could soon seek new opportunities. Are the trillions sitting on the sidelines rocket fuel for the stock markets and other assets? I just want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They are all up there. When you subscribe, we want to give you a free gift. It's the report that we wrote based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Peter as much as I have. Please let him know. Hit that like and subscribe button and leave a comment below the video. It's now